the investment you're about to hear, which is the Grand Royale, a newly developed senior living facility in the MSA of Kansas City, Missouri, which is a place that I invest in heavily. Um, through the what we're talked about today is we're talking about why senior living, the investment highlights, the terms, cash flow, location demographics, and talk about the facility itself and then the team. It will be a relatively short presentation because I want to make sure that you guys have time to ask questions. Just as a note, this is a confidential presentation, so you guys have all been invited. Please do not share this outside unless you get our permissions first. So senior living is an asset class I love. It's an asset class REITs love and big institutions love. And one of the major reasons is the strong tailwinds of the silver tsunami. Today, more than 6 million Americans age 85, which is the target demographic for Grand Royale, and that's growing every year. So this aging population, combined with a chronic shortfall of supply of quality assisted living and skilled nursing beds, will yield unprecedented demand, spiking up rents as well as occupancy. Higher potential income is also one of the big factors. I love buying senior living facilities. It just generally yields higher cash flow. It typically has 80% higher NOI than multifamily units. And where you can charge potentially $1,000 a month for rent, you're essentially charging $4,000 a month for rent with only 3 times the expenses. With all these things in mind, you're able to get high local demand, especially you buy a submarket like Gladstone, where there's a lack of available quality supply right now. We build in communities like this, where we typically have 8 times the demand of assisted living and memory care or skilled nursing facilities. This allows us to quickly lease up within the year. So the Grand Royale is a 105 units, newly converted senior living facility. And we're buying it at below replacement costs. It also is enters the market with very little competition and strong local fundamentals. And this would be a 3-year preferred equity offering. So I'll highlight what that means. So there's really a few reasons why, there's really many reasons I love this property, but one of the big ones is its strategic location. It's in both a submarket that's well-to-do, which you generally need that kind of population to attract an audience, a rental group that will pay $4,000 to $5,000 a month in rent, which is what the Grand Royale would charge. We're able to then quickly lease up. This provides us the ability to provide our investors a preferred equity position that will yield 6, 12, and 18% a year over 3 years. This preferred equity is a lower risk profile than most equity positions, and similar to debt, but it still has all the returns like equity. It's also a short-term investment, only 3 years. We like to listen to our investors, and we understand that there are times where a 10-year investment makes sense, a 5-year investment makes sense, and we believe that a 3-year investment makes the most sense in this case. For this facility, this is a newly developed Class A facility. Why I like that specifically for this facility is that there are no capital expenditures, foreseeable capital expenditures to be placed into. So our predictable costs for future is very predictable. We have experienced management coming in place to manage it that we're working with in a couple other facilities as well. It also has a continuum of care with independent living, assisted living, and skilled nursing, providing residents the ability to graduate from one independent to assisted to skilled nursing. The investment terms are rather simple. You're investing in pref equity, where you get a fixed return of 6% or 0.5% a month that gets paid monthly in the first year, 12% the second year, 1% a month, and 18% the third year, or 1.5% a month. And this is paid monthly at a fixed return for 3 years. And because it's pref equity and because it's also classified as equity, you have an ownership interest, which means you will get um, all the benefits of a cost segregation study, yielding you a big K1 loss through paper depreciation that will essentially make these returns tax free or tax deferred for the life of your hold, which should be 3 years. I want to highlight what pref equity is for those who aren't familiar with it. What I like to liken it to most is really low risk. It's risk mitigation for investors. Investors of the Grand Royale will receive a fixed 12% return, annualized return paid monthly from profits generated by the asset. But there's a low barrier for us to reach that preferred return, which is 68% occupancy. Our expenses gets paid first, debt gets paid second, and then preferred returns. So this is a good way to invest in a very low risk proposition, but still get all the same benefits of investing in real estate from a returns perspective, as well as a tax treatment perspective. So very simple cash flow chart. I'm gonna try to be as it's very simple. You essentially put $100,000 in, you get $500 a month for the first year, you get $1,000 a month for the second year, and $1,500 a month for the third year. And for those who are a little bit more patient or seeking a little bit higher returns, we've created optional terms where for most of our investors, they will probably invest into monthly income shares that I've been referring to. But there are two different types of shares in addition where you can get it at the end of each year, a little bit more, or at the end of 3 years, a little bit more even then. So with the third year option being a 40% return relative to 36%, but paid at the end of 3 years. And so all these three are fixed preferred return investments. And I want to highlight the tax adjusted returns portion of this. Through the Jobs Act, 2017, really Trump tax cuts, that was a lot of goodies for investors, real estate investors. One of them is cost segregation and bonus depreciation. This allows us to essentially create a huge accelerated write-off for investors that gets recaptured at the end of the term. But that allows you to essentially have zero taxable income for the first 3 years, comparable to 17% returns. This is a pro forma that our management put together for us, and we've done something very similar, but we wanted to highlight the investor pro forma because we're planning to hit 57% occupancy in the first year, 92 in the second, and stabilize afterwards. That's going to generate a fairly significant cash flow. This provides us the assurance and sort of the confidence of reaching the preferred equity returns of 12%. And because we're still leasing up in the first year, the returns will be 6% the first year and then 18% in the third year. The total capitalization for the project is $16 million. We're essentially buying a preferred equity position and retaining, using the 3.8 million from preferred equity and placing into the structure where investors get a 3-year fixed term. Our sponsors, myself included, and our developer partners are putting $1.2 million, $1.28 million into the term as well, and then creating, and then their equity would not be paid until the end of your third year. So that allows our investors to get the returns first. And we're getting an $11 million loan at a 68% loan to value at a very favorable 4% rate on this type of asset. And again, this is preferred equity, which means there are no asset management fees or acquisition fees or any kind of fees, as really the investors get preferential treatment and get the investment first. The timeline is we will be closing on the property in mid-January. So we're hoping to, for if you guys are considering investing in this, to review the documents. If you're investing, review the documents, review the pro forma, review of the deck, review the investor video, and ask us questions. But once you're ready, sign the subscription documents, private placement memorandum, and operating agreement, and then we'll fund and close. And the first payment will be paid out in the beginning of March. We'll hit stabilized occupancy by year 2, and we'll get capital return at the end of year 3. And for those who want to continue on to the next deal afterwards, we will have an optional 10-to-1 exchange, which I will be taking advantage of as well, and exchanging into the next property to keep deferring those tax benefits that you received and collecting more tax benefits on the new acquisition of the asset. This allows us to keep deferring the taxes that we would have owed on the cash flow, and also keep retaining more, collecting more depreciation benefits as we acquire the next investment. Of course, this is optional, so you can exit at 3 years or you can stay at 3 years. Why I love this location is there are a lot of feeder hospitals near Gladstone, Missouri. Specifically, Kindred Hospital, North and Liberty Hospital. These hospitals are great feeder systems for our skilled nursing facilities. Skilled nursing is really a temporary place where folks cannot stay at a hospital longer. They have to go for 1 to 2 months physical therapy, rehab, or other types of rehabilitation. Typically, our skilled nursing will be leased up faster because when you get discharged from a hospital, you typically have to get discharged to a skilled nursing facility like this one, or at home with a nurse visiting you almost every day, which is very cost prohibitive. By being discharged to a facility like this, you now can see all the amenities and the community that this facility has. And if you so choose, you can then continue to be an independent living facility or an assisted living community. So we have 2 options for you if you graduate from the skilled nursing.
Hey, Ing, we have a couple questions if you're okay to stop for a minute.
Yes, I've been talking too much.
Okay. Give you a breather here. So how exactly does preferred equity work? How are there no fees?
Yeah, so preferred equity, think of it as mezzanine debt. Essentially debt, right? If we charge a fee, we would essentially be charging ourselves more interest. You're essentially getting an interest-like return on a fixed term with that basically secondary to on a first lien debt, which is at 68%. And for all of our typical fees, our sweat equity, our salary, essentially that comes after pref equity gets paid.
Great. And do you have a minimum requirement on how much to invest?
The minimum requirement, we're making exception on this one. We're lowering it to $50,000. But of course, we would like to make sure investors come in where they're comfortable with. Most of our investors do invest at near the 200,000 level. But what we found to be very successful is a lot of our investors are repeat investors. Our last deal was funded by the vast majority by repeat investors. We would love for you guys to come in, get comfortable with us, understand how we operate, understand how these things work, and hopefully you guys will invest continually with us.
Great. Couple other quicker questions. $4,500 monthly rent seems high for the Kansas City area. Do you have data that shows that seniors are willing to pay that in the area or can afford it?
Yeah, so in the local area, our closest competition is charging $3,800 for a 1-bedroom. We're charging $3,900, and their facility is dated by around 20 years. We have a lot of amenities like a huge movie theater, a nail salon and spa, and these are all inclusive, right? You got to imagine that this is an all inclusive resort. Emphasizing resort a little bit too strong, but it's definitely a community that gives you free access to healthcare where applicable, and free access to foods, 3 meals a day, and all the amenities like any all inclusive resort. And that competition, by the way, is at 90% leased up. So that's how we feel confident that we will hit the same numbers, and while offering a very similar price range.
Perfect. And you may need to jump back to slide 10 for this next one. The question is, I won't hopefully need the monthly income right now. Can I defer 100% of my returns as far out as possible in the most tax favorable way?
Yeah. So as I mentioned, there are a few options to defer your taxes. One is first, getting the incomes later at 3 years allow you to get more returns, 40% versus a total 36%. That's something that our investors have chosen that on often as well. But for those who want to continue to defer those taxes, we will also have a tender exchange option where the Grand Royale investment entity, which will be co-titled in the investment, will essentially then tender exchange into the next investment, which will be a very similar 12% return, potentially single living facility. And when we do that, we essentially defer the gains or the depreciation recapture, collect new depreciation on the new asset, and hopefully then do it again in 3 to 5 years.
Okay, and then just a couple of questions that I can answer quickly here. When will I receive a copy of the investment deck? I think we're going to be sending that out tomorrow.
We'll send out tonight.
Tonight, perfect. And then do you require accredited status?
This one is a 506B offering, which means for a few folks, we will allow sophisticated investors up to 35.
Perfect. Okay, I think we're good for the moment. I'll stop you again in a few minutes.
Okay. All right. Yes, please ask questions. I want this to be interactive as possible. And I go to this material a lot, so I can bore myself as well. I don't know what everybody knows, so I would love to tailor this as much as possible for this audience. Another reason why I like this investment is specific demographics and location. It's a well-to-do area. It's a place that I have tried to buy multiple apartment buildings in, but the returns aren't there. In senior living, returns are there. And the population is also aging. This is relatively higher than even the general population in America. A demographic like Gladstone, a place like Gladstone, some people may ask, why would somebody go to a senior living facility in Missouri, in Kansas City? Why don't they go to Florida? Well, first of all, we do have investments in Florida. But what I found is people want to be home. People want to be part of and close to their families. They don't, if their families are still living in Kansas City or in Gladstone, they don't want to be too far away from the families. Their families, their children, their grandchildren, they want to visit them. But if you move to Florida, what we've seen is you move there to live independently. But when you need assisted living, you actually move closer to your family because you're at that stage, you're sort of at your end of life. So at that point, you want to be close to family as possible. So we make sure that the amenities, the community, all the aspects of living here feels like home. You can bring your own furniture, you can bring your own fixings, and you can bring your spouses and your loved one, your friends, and we will have a referral program, and we will create a community so strong that that's what's going to be a big driving force in this type of community. 105 beds, 100 potentially 120 people in the facility. That's why we're developing this. That's why I love acquiring these type of assets. So this has a continuum of care, and typically the continuum is independent living, which is designed for essentially like an all-inclusive resort, but you can walk around independently, to assisted living, where you cannot no longer safely provide for yourself and you need 24-hour help. You still have the same access to every one of these types of amenities as well. And then you have skilled nursing. And skilled nursing is sometimes a feeder for the other two, as I mentioned earlier. Skilled nursing is essentially, for having 24-hour registered nursing care. And oftentimes we get our patients from hospitals that get discharged from the hospitals as a short-term care facility into skilled nursing.
Okay, and I've got a few more questions for you here.
Mhm.
Okay, so going to the fixed returns, I think it's probably worth explaining this part. If the vacancies, if there's large vacancies, how would that potentially impact the fixed returns?
So the good thing is that uh, the returns needed to hit the fixed returns in the first year is very low bar. We should probably hit that in 2 to 3 months. And we have enough capitalization to pay the rest of the returns. Yeah, remember, the 1/4 of the sponsor equity, the $1.28 million, will not get paid. All of our fees that we typically would have charged would not get paid only until you get your fixed returns, and then you capital it back. This is really ensuring the priority of the investors. This is as fixed and as predictable as you can get.
There are a lot of questions about the environment with COVID and social distancing and occupancy rates. Can you talk to that and maybe some of the unique risks, if any?
Yeah. So over the past 6 months, the leasing has stagnated across all senior living facilities. That has allowed us to acquire this asset at a $1.5 million discount. If this environment wasn't happening, we would probably have to overpay because this is still a very hot asset class. So buying right is first step in the game. Um, what we've seen is the average occupancy for these type of facilities have went from 92% to around 88% over the past 6 months. Uh, remember that we need to hit only around 60% to start being able to hit the full 18% preferred equity return payment. That's a very low bar to hit preferred equity, to hit the fixed returns to investors. Because of the structure we're trying to create, we're trying to make it as de-risked as possible to investors. Another part of it is, of course, COVID itself. One thing that we've developed for our other facilities is these visitation areas where we have glass in them. I'll show you what that looks like. And this allows our staff and visitors to come in. They get temperature checked and checked across the board. And these special visitation areas allow them to still visit family members, but de-risk it, eliminate that risk for the exposure to the community. Now, I did get word from the operator that they will be getting the vaccines in the second week of January. I have asked them to save 2 for me. I don't know if I can do that, but you know, I wouldn't have to
Worth
try.
asking. There's a question about your experience or Tozzi's experience specifically in healthcare and senior living and managing that type of asset.
So our investment partner, I'll just go straight to that. Our investment partner, Chuck, has several senior living facilities that he's owned and developed, as well as a home care facility. I have acquired and own and operate 2 myself, and we're acquiring 3 more in the process. This is an asset class that we're going deeper into. We are not the operators, though. We will have Dan and Jeremy, great guys, and have a lot of experience running these nursing and skilled nursing and assisted living facilities. They have many communities across the country, as well as have really good understanding of how to staff up. And really, with these type of facilities, you have to have the right staff, the right nursing staff, the right care staff. And the good thing is, labor is relatively cheap right now. We can get folks on relatively affordable terms, so that would reduce our expense ratios.
What source do you anticipate the revenue to come from? Private pay, Medicare, Medicaid?
It will be majority private pay. For skilled nursing, it will be we will accept Medicare, Medicaid, but it'll be majority private pay, and that's one of the reasons why for our facilities, it's going to be the least headache of the three types of pay. Most of our facilities where we don't have skilled nursing, we don't generally accept Medicare, Medicaid because of the regulations. However, because we have skilled nursing and because these are discharge essentially units, beds, this allows us to easily receive patients with systems in place that allows us to collect on the rent essentially.
Great. And this is a little bit more logistical with self-directed IRAs. We become an LLC member as a limited partner. That's correct. That was a question. The answer is yes. If we use a self-directed IRA, we incur UBIT tax, right?
You incur UBIT tax on the exit, I believe. So a solo 401k would be ideal. But because you're also, on this case, the principal does not appreciate, so that might not be a factor.
Okay. We do have a few more questions, but we'll kind of hold them for a little bit.
Yeah, I'm almost done, guys. So the deck is relatively short, and we will definitely share this tonight. So the floor plans are such: studio, skilled nursing, 1 bedrooms and 2 bedrooms, and these are artist renderings. But essentially, what we're trying to convey here is a very 1920s feel, a community. Dining room, bar, wine bar, beauty parlor, atrium, main, we have bingo parlors, art studios, all the amenities that you could imagine for this type of facility. That's allowing us to be very competitive in the marketplace. That allows us to also charge a premium and be able to quickly return the fixed income to investors. These are example interior units, fully furnished. And I talked about myself and the investment team and the management team. So we're very happy to bring in Dan and Jeremy. They have a lot of experience across all these same type of facilities, and they've helped us execute on the last stages of development in the last few months. So we brought them in early to make sure that they are able to operate to fit. All right, that's it.
Great. Okay. Still, please keep sending questions. We're still filled in a few, but we'd love to see more from the group here. So can you talk about the total number of units and the breakdown of independent, assisted living, and nursing home units?
Yes, there are 105 units, and there's 43 independent living, 34 independent living, and I'm gonna have a picture of it. It'll be on the data room that we will send. The way that you can imagine this facility looking, it's two spoke and wheel patterns. For essentially one wing that's all independent living, one wing that's all assisted living, and then skilled nursing sprinkled in between. And so this allows us to collect feeder discharges from hospitals into the skilled nursing, and then convey them up to independent living or assisted living. And we have the certificate of needs, essentially the regulations and the approvals and licenses to operate the assisted living and skilled nursing already.
How do you screen potential tenants?
So typically the screen, if you're referring to financial screen, we ask for not really a credit check, but we look for a financial check, like essentially looking at the bank records, the IRAs, their retirement accounts. At this stage of their life, they mostly have annuities or retirement accounts that will be used for their care for the remainder of their lives. We want to make sure that they can afford it, but in this general vicinity, there's a huge demand for it. So we have already pre-leased the building, started to pre-lease the building, and we already have at least 14 commitments in the assisted living and independent living centers.
Similar on that, Ang, is the project already completed? What's the construction timeline? If not, when will residents begin moving in?
It's got completed this month, and residents will start moving in end of next month.
Will the rate increase year to year? If so, what will it be and how is it determined? That's slide 10 again.
Oh, yes. For the returns, it will increase year to year. So essentially, it was 6% in the first year, 12% in the second year, and 18% in the third year for the monthly income shares. And if we hold on for longer than 3 years, which we do not plan to for at least a pref equity position, you essentially get that 18% every month afterwards as well, annualized.
Let's see. There's a few questions about the appreciation on exit. So can you explain about the lack of appreciation on exit and what you expect that to look like?
So the exit will essentially come from a refinance through a HUD loan. So we're essentially bringing it from zero occupancy to lease up with essentially the bank financing at 68% leverage, and then a pref equity position, which the investors will come in at. And so that will be essentially a safe position relatively. And because it's pref equity, there is no appreciation on the capital, although there'll be high cash flow, predictable cash flow. What was the second part of the question, Brett?
The question was really about the appreciation. So I think it's a question of we're doing fixed income here versus having an upside at the end.
Yeah. So I love both type of investments. We have investments that will be profit sharing. And of course, profit sharing means risk sharing. So this is sort of de-risking it as much as possible, still providing high monthly fixed returns. So if you're investing $100,000 by the 13th month, you'll be receiving $1,500 a month by the, $1,000 a month. And then by the 25th month, you're being $1,500 a month. It's very predictable and it's fixed and it's really low risk.
There's several questions about investing with IRAs. So first question, can we invest in via IRAs? The answer is yes on that.
Yeah.
And then another question is, can you elaborate a little bit more on what you were referring to with the taxes and self-directed IRAs?
Yeah, so if you use a self-directed IRA, typically when you make a profit on it, you do pay an unrelated business income tax. So if you're investing in real estate, and typically people invest in real estate through buying real estate, not necessarily to invest in these type of private equity investments. When you sell and capital gains, you then pay unrelated business income tax on it. If you invest with a solo 401k, set up a solo 401k, get paid $1 by your company. That's generally the bar. And then you don't have to pay the UBIT, unrelated business income tax.
There are 2 or 3 questions about the structure between you and Chuck and Jeremy and Dan. So the first one is, how can we check out the operator and their track record and how their staff is, any of their other assets that they've been managing?
Yeah, I will happy to share that with you guys. Let me know. Just reach out to us afterwards, and I'm happy to share their track record. That's something that we thoroughly vetted before we hired them, and we've, the good thing is that in our other buildings, we are already hiring them for another facility from Chuck that he owns and operates. In terms of the structure, ownership structure, Chuck and PJ, essentially the developers of the project, are the ones who essentially developed it. We're recapitalizing a pref equity position out and then putting in around significant amount of money into fixtures, furnishing, and equipment, and then around $1 million into an operating account. That's the basis of the leverage of that capital, $3.8 million.
Speaking of Dan and Jeremy, are they going to be moving into operation roles or transitioning to new roles with the project completion?
Oh, they're transitioning to operation roles. They will operate the Grand Royale.
Great. And then just, I guess, reiterating Tozzi's role as let's see, you are the property company only, and you have an independent operator who will operate the healthcare business. So your structure between Chuck and Tozzi, I believe, is the question.
Between Chuck and Tozzi, or between us?
Yeah, I think the question is Tozzi actually operating it, or is Tozzi more like hiring an independent operator?
No, we're hiring an independent operator. So Lulu, so Jeremy and Dan are operating it. Their company that they own will operate it. So we're essentially paying them a 4% management fee, along with salary for their staff.
Where do you see senior living headed in the future compared to other real estate classes?
I think there's a lot of tailwinds to senior living. It's an asset class that will eventually be overbuilt, like a lot of asset classes that have high yield. Currently, the cap rates for this type of asset trades at 7% plus. For stabilized asset, even lower. So that's typically 1 to 2 points higher than multifamily. In 2040, there will be 600,000 bed shortage. Right now, there's around 150,000 bed shortage. This can create an unprecedented demand and allow you to quickly lease up at these higher rates. And remember, these rates aren't really that high relative to long-term care in general. If you're staying at a hospital, that'd be a lot more expensive. If you had home care staff coming in to visit you, it could be as high as $10,000 a month. And for those folks receiving this type of care, receiving this type of amenities, this is potentially this last 2 to 3 years of life. And they're leveraging their entire retirement funds that they've saved up for this type of situation. Any other questions?
Another one on Jeremy and Dan. Do you have are there any concerns with Dan and Jeremy taking over operations from previous administration management?
No, we've thoroughly vetted them out, and at least I have personally as well, and Chuck has used them on another facility, and they own and operate several facilities across America as well.
Great. I don't see any other questions at this point. Are there? I guess we can hang around here for another minute, see if any other questions come up.
Yeah, I can hang out here. One thing that I really like about senior living is that it's one of the needs-based assets. In multifamily, you need to live somewhere. This type of facility, you might not need the amenities, but eventually, once seniors use this type of amenities, they will see it and they will like it. I think that's something they'll gravitate towards. Senior living is also one of those type of assets that can potentially have a lot of tailwinds, not just on demographic shifts, but because of the fact that the aging population will essentially also have more residual income for this type of amenities. If you look at the economic distributions and how millennials and then older folks, this type of population will have more economic means to then definitely pay for this type of facility and amenities.
Okay, several more questions came in, so definitely lots of interest, which is great. Thanks, everybody. What would you say, and you sort of worded, you answered this a little earlier, but just kind of rephrasing this a little differently. What is the worst case scenario for this investment?
The worst case scenario is if um, we we aren't able to pay the debt. I think that's in generally the worst case scenario for any type of real estate investment. If you aren't able to pay the debt, then you have significant issues, holding on to the asset. The good thing is that for the first year, we are capitalizing enough to essentially pay the debt regardless of cash flow. So that's allowing us to have a year buffer to then lease up. That allows us to hit our targets, which we're targeting by mid 2021 to be at around 35 to 38% leased up, allowing us to hit our debt marker, which is where we need to hit to be able to pay the debt.
Great. Okay, there were a couple questions about that. So just let me know if you have any other follow-up questions related to that, but hopefully we answered that. How much more funding are you looking for this investment?
We are around half funded, and so we're looking for another half of the funding.
Did your pro forma include annual rent increases?
It does. It includes annual rent increases in the second and third year. The first year will be heavily discounted based on trying to get new tenants in. And as soon as we get stabilized, we'll start moving up to market, although we won't move up to market until year 3.
Are you personally planning to keep the property post refinance?
The entity that will own a GGCC along with Chuck will hold it afterwards. So I am participating in that, but I will also participate in the Grand Royale and then tender exchange into the next property.
What if we need to, for whatever emergency comes up, we need to exit before 3 years?
So with most investments, I think it's obviously the pros and cons is a liquid type investment. 3 years is pretty short, but if you need it earlier, what would likely happen is you would sell your preferred equity position to potentially us. I would typically buy it if you're selling it at essentially costs. I would probably buy it from you because at that point we're making 18% on that third year. If you want to sell it for a little bit more, say $110,000, that would probably be another negotiation.
How would we be taxed at the end of 3 years if we choose to take out our investment?
You will be taxed on the depreciation recapture. So that depreciation that you would have gotten essentially gets recaptured in the form of long-term capital gains, capped at 25%. That essentially is what you would pay, and really is a deferral of the taxes that you've gotten early on. If you did not use all the depreciation during these first 3 years, which you wouldn't if you didn't have anything else, you essentially then can use that depreciation to then eliminate or reduce that depreciation recapture. So if you didn't use any of it, you essentially owe nothing at the end of 2 years. The good thing is that you'll be using it to get tax-free cash flow for the first 3 years.
So that what you're talking about there is a bigger advantage of the short hold period.
Yeah, it's a big advantage short hold period. And the ideal way for investors to keep deferring their taxes is to keep investing. By keep investing your principal and your capital, you're able to collect more losses, more depreciation losses that allows you to offset more of your income. This is an endless cycle of keep investing. Invest for cash flow, live off the cash flow that would be tax-free. Keep investing the principal. Then principal generates more losses. Keep deferring that, tender exchange it. Sometimes you don't need to, sometimes you need to. Those are the type of strategies that real estate investors leverage every day to reduce their tax liability.
And bonus depreciation would be in 2021, right?
Yes, we will start bonus depreciation at operations.
And follow-up question, cost segregation would also occur in 2021 after acquisition, right?
Yes, cost seg is a precursor to bonus depreciation.
What are your marketing sources to drive up the census?
Can you say again?
What are your marketing sources to drive up census? I think just marketing for residents.
Oh, to get leasing, yes.
Yeah, I think that's the question there.
So we have three types of programs. One is really the traditional paid advertising, and this is both online, mostly Facebook, and then offline in newspapers and local, flyers. We're trying to really target the children of the residents. That those are the people who typically will quite often make decisions, um, or at least give the nudge for the assisted living. Another way that we're getting a lot of our marketing and leasing up is through referrals. So we're able to work with doctor's office, physical therapists, and other facilities that typically sees a lot of seniors in this age range to then refer to us. The third is similar to that is hospitals. Hospitals discharge around 20,000 patients a year in this 5 mile radius. Around 1/10 of that needs to be discharged into a skilled nursing facility like this one, or needs to have 24-hour nursing care come to them, which is quite a bit more expensive. So with our operators, we have those relationships with these local hospitals to then make sure that we're a top priority when they consider discharging to a skilled nursing facility, that they get discharged to us. Once you become a tenant or essentially a care under skilled nursing, you typically could stay for as long as 2 to 4 months, but not longer. It's not a long-term solution. You don't need skilled nursing forever, but if you do, there's that option. But typically, then you graduate or you move to independent living or assisted living, if you, depending on where you're at in your health cycle. This allows us to quickly get quick leasing. Around 60% of our skilled nursing will be leased up in the first 4 months, and then feed into the other two type of facilities: assisted living and independent living. Brett, you're on mute.
Sorry, thanks. So I'm starting to type the response on this question already, but curious on your answer. Do you think we can have a yearly review with Dan and Jeremy to see how the property is doing?
Yes. So one thing that we try to pride ourselves on at Tozy Capital is being as open, transparent, and communicative as possible. I have been an investor, and when I have a poor experience, it's almost always a lack of communication. I want to make sure that you guys have a gateway to us. If you're an investor or if you're considering investing with us, feel free to reach out to us, schedule time with us. We will also be providing monthly reports, quarterly webinars, and be as accessible as possible to our investors to give you updates on the project and all the other investments.
I love this next question. How would you compare this expected returns on this investment compared to, say, an investment in Stony Brook Towers?
So for those who don't know, Stony Brook Towers is a common equity type investment. And when I've seen common equity type investments or these type of investments, when I see them typically stacked is you have common equity and then you have pref equity. The pref equity actually is the more popular one. You can think of it as debt. So relative to common equity, it does not have the upside, but does not have the downside risk. Stony Brook Towers is a 10-year hold also. A lot of our investors, potentially you guys, prefer the 3 years. So a 3-year hold is definitely something that this is slated for, will deliver on, and provide a really high return over those 3 years. I love both investments. It's like saying, which child do you like more? So it's hard to say. I do love senior living facilities. I like pref equity for investors just because of the minimal risk that it does provide.
And I think the best part is we just have both assets because we're looking, there's different advantages to both, like you're saying there. What is the pricing for low to high per unit?
The pricing is around 2,900 on the studios, and then high of 4,400 on the 2 bedrooms.
And there was a Wall Street Journal article today about COVID potentially increasing demand for senior housing care. Did you see that? Does that resonate with what you're seeing?
What was that?
There was a Wall Street Journal article today that said that COVID was having a significant impact on demand in senior housing care. Is that something that you've seen from your experience as well?
Yes, it has. So over the past 12 months, the impact on leasing has been significant. So if you're in a profit sharing model, this would concern you dearly because you're really caring about how optimally it's leased up. If you're in a pref equity position and the requirements to get that 12 to 18% return is only 68% lease up, then if we lease up to 70%, you shouldn't really care. If you lease up to 90%, you shouldn't really care the difference between 70 and 90. That's why we love the pref equity model. What we've seen in the market and what all the research has shown is a 4 to 5 point dip in occupancy from 92% to 88%. Again, we need only 68% occupancy to hit the preferred equity return numbers for investors. And for the first year, that isn't even a requirement.
Do you accept hospital discharge patients of all ages?
No, because typically for younger patients, they will get to physical therapy. It's not necessarily age restricted, but I believe there will probably be enough type of options for younger folks to get discharged into.
Sorry, I'm skimming through questions here, make sure we've got everything answered. What rate would I receive if in years 4 and so on after, if I continue with the investment?
It'll be 18%.
This is a tax question, but we'll still ask. Can the capital gains be applied against the depreciation provided via Grand Royale? Okay, so rewording that, can the depreciation benefits of Grand Royale offset the capital gains from stock?
So there are 3 types of income or P&Ls. One is a active P&L, active income. Second is a portfolio income, sell stocks, and third is a passive income. These 3 generally do not intermix. So when you get passive losses, they cannot generally be used against active gains or active portfolio gains. So to answer your question, no, typically. Although if you're a real estate professional, all those 3 things merge together.
Okay, I think this is our final question here. What do you anticipate the stabilized asset value to be at the time of refinance at the end of year 3?
Stabilized asset value would be roughly 22 million.
Okay.
I'm happy to share the appraisal report for those who want it. It's a 256-page report with a lot of facts information on senior living, effects of COVID, the relative stabilization of the property, and a bunch more pro formas.
Great. Okay. A couple more questions coming in. How would you handle seniors who run out of funding?
You kick them out. I'm just kidding. I think it's for those with private pay, it's pretty predictable what kind of funds they have, how much they would have. I generally, I have not seen an issue with retaining tenants because of financial means. Unless something severely happens, then we potentially have to potentially reduce their, if they're in a bigger place, maybe they move to a smaller place. But if people cannot pay altogether, I definitely think that's a conversation we will have, and potentially we have to ask them to leave.
Okay, and back to the real estate professional question, can you offset passive losses from other investment properties?
Yes. So that's the great thing about depreciation. If you invest now on something, you can then use the depreciation for other passive income. And so you should ideally always be investing every year, so you're always collecting more losses. And then hopefully 1031 exchange into another property so that you can defer those gains and recapture and get more losses as well.
Would you accept additional investments during the 3-year period?
So we do not need additional investments after the initial capital. So our expectation is that we would not be accepting additional investments.
Okay. And you answered earlier, but just asking again, how much more is Tozy looking to raise for this? And if it's not raised, could it put the project at risk?
So we have a $3.8 million raise. We're working with, we have nearly $2 million of that committed, and working with our partners to ensure backstopping the rest of it, so that we can complete the project. We don't need the full 38 million to begin operations. However, we will have $1 million in operating account reserves to manage the first year of expenses. At that point, we'll have a lot of cash flow coming in. So there's a chance that we could reduce that equity amount. However, because the preferred equity position is fixed no matter what.
And what is the legal vehicle you recommend investors use to invest in the project?
There are 3 typical vehicles we use: individuals, trusts, or LLC. I would recommend a trust. When you say, can I use, yeah, I mean, really the LLC is more of a liability asset management issue. And because you're an LP investor in preferred equity and you're not on you're not signing on any loans, we're signing the loan, you have almost no liability.
Okay, I think that's all of the questions. Need to wait another minute here.
And so for those who have any additional questions, we will be sending an email right after this, after getting dinner, and include the webinar recording, in addition to the other documents that I referred to, and my calendar link. Feel free to reach out to me, schedule time with me. I would love to hear from you, answer any additional questions you might have, provide you any additional information, pro forma, anything else that you might need to know. I'm always happy to be as open and transparent with you as possible.
Great, and we did have 2 quick questions I'll just go ahead and answer. So how would you calculate depreciation per investor? Number of investors accept IRA versus company? I believe the answer is we go off of the percent of ownership, but we don't exclude IRA.
But IRA do not get any depreciation benefits because they can't leverage it. So a K1 is not useful for an IRA investor. So it will be a pro rata except IRA. So you're correct, Paul. And by the way, the pref equity position will be collecting 75% of it because the other 25% is funded by the sponsor equity.
Great. Okay, I think we're all set. So I've shared my email with a few people there as well. Then we've also got Ing will be emailing out the docs later tonight. So please let us know if you have any other questions. I'd love to help.
All right. Thanks, guys. Have a good night. And if I don't talk to you guys, Merry Christmas.
Merry Christmas. Thanks, everybody.